morning, this is Clay Kramer, VP Controller. Today I'm going to share with you a little bit about internal controls and how they affect us every day at AgCountry. The question is, what is internal control? Internal control is a process affected by an entity's board of directors, management, and other personnel designed to provide reasonable assurance regarding the achievement of objectives relating to operation, reporting, and compliance. This definition comes from the Committee of Sponsoring Organization of Treadway Commission, also known as COSO. COSO is a joint initiative of 5 private sector organizations to combat corporate fraud. COSO is a commonly accepted framework used to design and apply internal controls.
But Clay, we have processes at AgCountry. Don't those count as controls?
Processes are great, but being a process does not make it a control. However, a process can be turned into a control with a few things. First of all, a control needs to have measurable documentation. An example of this would be something like a loan approval. A loan can be approved verbally, but also can be approved in writing. For a control to operate, we would need to have it down in writing or some sort of measurable documentation to prove that the loan was approved. The second item is a control needs to be tested by an independent party. For AgCountry, our independent party is our internal audit department. Our internal audit department selects independently a random sample to go through and test the control documentation. And the third item would be a control needs to operate every time. There's no margin for error. Within the COSO framework previously mentioned, a 3 lines of defense model is used. Take a look at my screen and I'll show you. The 3 lines of defense model is shown here. The first line of defense is shown off to the left and includes management controls and internal control measures. This would include AgCountry employees operating controls as part of their everyday jobs. The second line of defense would include myself and others in the finance team that assess risk in our internal controls framework as part of our everyday jobs. The third line of defense would be the internal audit function. Our internal audit department assesses whether controls operate and are designed effectively as part of their sampling. All this comes together so that our external regulator and external auditor can rely upon our work in our framework. Our external auditor in this case would be PwC, and our regulator would be the Farm Credit Administration. Let's go over a few examples of controls. One common example would be reconciliations. Reconciliations are completed for all balance sheet accounts to ensure our financial statements are accurate. The second example would be that loans are properly approved within delegated lending authority. A third example would be access to all IT systems is reviewed and appropriate. And entering a wire is different than a person releasing a wire to ensure proper segregation of duties.
Clay, what is the difference between internal controls and ICFR?
That's a good question. Let's take a look at them a little closer. If you remember back to the COSO definition for internal controls covers operations, reporting, and compliance. Internal control over financial reporting is a subset of internal controls. ICFR is focused on the reliability of financial reporting information. AgCountry's current focus is on ICFR with our 2019 attestation.
What exactly is the point of ICFR?
ICFR can be summed up in a few brief items. The first would be to detect or prevent errors or fraud that could result in material misstatement to our financial statements. Another would be to address the risk of material misstatement. And the third would be to provide reassurance that our financial statements are accurate. When I'm referring to our financial statements, I'm referring to our quarterly shareholder reports, as well as our annual report that is audited by PwC. Around the turn of the century, a few corporate accounting scandals helped shape the environment for internal controls. The first event that happened was Enron. Enron was an American energy and commodities company. Special purpose entities were created to mask liabilities. This made Enron seem more profitable than it actually was. Another example would be Arthur Andersen. Arthur Andersen was formerly one of the Big Five accounting firms. They reported roughly $100 billion in revenue through institutional and systemic accounting fraud. Arthur Andersen was the auditor for Enron. And another example would be WorldCom. WorldCom was an American telecommunication corporation, and they were booking line costs as CapEx items on the balance sheet instead of expensing them. This inflated assets by roughly $11 billion. These examples of fraud brought to light the need for internal controls.
And don't forget about SOX, the Sarbanes-Oxley Act of 2002, named after Senator Sarbanes and Senator Oxley. This was in reaction to major corporate and accounting scandals. It holds management accountable for accuracy of financial information and restores trust and confidence in the public securities market. One of the many requirements of the Sarbanes-Oxley Act is that publicly traded companies receive an integrated audit opinion.
We've covered a lot of material so far today, so let's review some of the terms. The first term is internal controls. This covers operations, reporting, and compliance within a company. The next term is ICFR, and that is internal controls over financial reporting, and that is a subset of internal controls. The third term is SOX. This is the legislation that makes ICFR a requirement. The next term is integrated audit opinion. This is an audit opinion over our financial statements as well as our internal control environment. And the last term is full attestation. This is synonymous with an integrated audit opinion.
I think we'd better explain how the ICFR journey is applicable to Egg Country.
Publicly traded companies were required to receive an attestation after SOX was passed. The Funding Corp voluntarily adopted an attestation in 2005. A few years later, a few items occurred highlighting the need for enhanced internal controls. One of those was the misclassification that occurred during the year-end audit over the FC loan type classification. In reaction to this, the President's Planning Committee and Funding Corp agreed upon an enhanced framework in 2015. This included system banks being required to receive an attestation starting in 2017. Egg Country is currently one of two associations that is required by FCA to receive an attestation. Egg Country has a huge impact on the Farm Credit System financial statements due to our size. Egg Country's financial statements and all financials from all entities comprise the system financial statements presented at the Funding Corporation. The Funding Corp sells bonds to Wall Street investors to obtain funding for our customer loans. These bonds are sold with the funds going to the funding banks, in this case, Agribank for us. And Agribank provides those funding to all associations to make loans to customers. As of 12/31/2018, the Farm Credit System had total assets of $349 billion. This would make the Farm Credit System the 12th largest bank in the United States. As a frame of reference, US Bank is $464 billion and the 7th largest, and Capital One is $362 billion and 10th largest. Being part of the Farm Credit System gives us access to funding at a competitive advantage, which in turn supports our customers. Investors make decisions on whether to buy our loans based on the information we collectively supply. If the financial information is delayed, inaccurate, or has to be restated, that can impact our ability to obtain funding needed to lend money to our customers and can impact our reputation. With the number of controls Egg Country has, some items will periodically not operate as intended. These items are called deficiencies. Management needs to assess the level of each deficiency and in aggregate. The three different types of deficiencies are control deficiency, significant deficiency, and material weakness, with material weakness being the most severe.
These deficiencies are reported to ELT, the Board of Directors, Agribank, and the Funding Corporation. Material weakness would be reported in our financial statements as well.
Let's touch on a few focus areas or hot topics that are currently going on with financial statement audits as well as internal controls. The first of which is key reports and spreadsheets. And this largely revolves around how does management know they are complete and accurate with all the data and formulas and pieces that are moving around. The next item would be segregation of duties. This is the primary driver to prevent fraud and to make sure that one individual does not have too much authority. The third item would be review level controls. And this is what evidence and documentation are available to support the conclusion or the review that you are completing. And the last piece is related party transactions or official loans. I wanted to summarize the content and provide a few key takeaways. The first of which is Ag Country executes internal controls to ensure commitment to our core value of integrity, to safeguard the viability of competitive funding, promote customer and stakeholder confidence, and achieve our business objectives. The second takeaway is internal controls are administered through oversight, execution, evaluation, and reporting, and this is completed by all employees throughout the company. And the last key takeaway is FCA regulations. While FCA requires the system banks and a few associations to receive an integrated audit opinion, it does help to ensure the safety and soundness of the system as a whole. So rest assured, our financial reports are reasonably accurate.